Hello, welcome back to this week's market update. Today is Monday, May 20th, 2024, and we had a very full week last week, notching some all-time highs, so we'll jump right in. Stocks rose last week on a cooler than expected CPI print, as well as some softer than expected retail sales data for the month of April, sending stocks to all-time highs last week. As of close on Friday, May 17th, the S&P 500 gained 1.5% on the week, the Nasdaq Composite up 2.1% on the week, the Dow Jones Industrial Average up 1.2% for the week, surpassing the 40,000 mark for the first time in history. And then finally, we saw the Barclays Aggregate Bond Index also up just about 0.5% for last week. Perhaps one of the largest catalysts of last week's market rally was the April CPI report, the Consumer Price Index, where we saw headline inflation at 3.4% on an annual basis. So that came in lower than expected, encouraging markets that inflation is not becoming too sticky and it's not rising abruptly. And then we also saw the core CPI number, which excludes food and energy, that came in at 3.6%, and both were slightly down from March's numbers. So overall, it was a pretty solid month of CPI data, definitely a lot better than March's data, and we'll take a look at some of the drivers in the next slide here. Breaking down the CPI report a little bit further, we can see food here was up only 2.2% from a year ago, with groceries up only 1.1% from a year ago, and then most of the inflationary pressures coming from the food away from home, aka restaurant category there. We saw energy as a whole rise 2.6% from a year ago, with gasoline up just about 1.2% from a year ago. So you might see higher gas prices. You can see it was up 2.8% in the month of April alone. So it was higher than the March gasoline prices. However, from a year ago, it was only up 1.2%. So that's important to note. We also saw used vehicles actually down almost 7% from a year ago. So that's quite notable there. A lot of softness in the vehicle market. And then shelter was up 5.5%. So that's one of the things that we're seeing a lot of stickiness in is the rising cost of shelter. And that is up still 5.5% from a year ago. So quite notable there. And then we'll get into the producer price index in the next slide. Contrary to the CPI coming in lower than expectations and encouraging markets, the April PPI, or the Producer Price Index, came in hotter than expectations, which the market mainly ignored. However, I think we should be paying a little bit of attention to this bit of a jump in inflation that we saw to producers in the month of April. Headline inflation clocked in at 2.2%. To producers, and then core inflation, which excludes food, energy, and trade costs, clocked in at a higher 3.1% inflation rate. But you can see here both were quite a bit of a jump from March's annual inflation rates. Then looking at a monthly basis, headline inflation rose 0.5% compared to the 0.3% that was expected, so quite a bit heavier on a month-to-month basis there. And then core inflation was expected to rise about 0.2%. However, it rose twice as fast at 0.4%. Now, this is just 1 month of data, and you can see in the category of goods, that was up only 0.4% compared to the 0.6% increase in the cost of services. However, producers often pass on their higher prices to consumers. So when we're looking at a hotter than expected producer price inflation, we often see that later on, maybe 6-12 months down the line, when producers have to pass on their higher costs to consumers, thus driving up the CPI eventually. Moving along through last week's market news, we also got April's retail sales data showing a flat month-on-month increase. And then when you exclude the impact of weak auto sales, it was up slightly, 0.2% month over month. And you can see that there. We had quite a bit of a drop in auto sales here, and then general merchandise were also negative, leading to an ultimately neutral month-on-month retail sales number. Other categories that were notable in this report, non-store retailers, aka online shopping, that was up still 7.5% from a year ago. Food service and drinking establishments up 5.5% from a year ago, so a lot of strength in those categories. And then on the weaker side, we saw furniture store purchases down 8.4% from a year ago, and then leisurely activities, sporting goods, hobbies, instruments, and bookstores, they were down almost 5% from a year ago. But overall, the market took this report to be quite positive. The market is seeking less uncertainty about a potential rate cut coming in September or hopefully sooner, but the odds are right now pointing to September for the first Fed rate cut. And every time we get a slightly softer than expected, but not recessionary economic data point, it kind of points to a higher chance that the Fed will cut on pace with these expectations. So this is also one of the reasons of last week's market rally, as the Fed is hopefully going to cut rates by September. Last but not least, we also got the leading economic index for the month of April, which showed a decline of 0.6% month over month here. However, it did improve on a 6-month growth rate basis. And then looking at this chart here, just briefly, this was the second month that it was above this recessionary signal, which is a good sign that we might get through this little road bump without seeing a recession like it typically signals. You can see the last 3 recessions, even the very short COVID recession, all of them had this red flashing signal, but so far we have not had 2 quarters of negative GDP growth, which is typically one of the key defining factors of a recession. Then looking at April and seeing why that data maybe was a little bit less rosy than expected, you can see the S&P 500 led that slightly lower, as well as the interest rate spread, the negative yield curve that showed a small decline in the index as well. And then the non-financial components, we saw consumer expectations. That was a bit of a decline in April, as well as new orders and building permits. So those all led to the decline as well. Overall, it looks like we may be getting through these very bearish signals of a recession without actually seeing a recession, at least according to this index. So that was good news on that front. Thank you so much for tuning into our market update this week, and we look forward to providing another update to you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.